In this video, we will explain the accounting for tax loss carryforwards and walk through a problem that involves both a net operating loss carryforward as well as a net operating loss carryback. Net operating losses occur when tax-deductible expenses exceed taxable revenues. Taxpayers can use the loss of one year to offset the profits of other years. The company will pay no income taxes for the year in which it incurs a net operating loss and then carry the tax loss forward to reduce future taxable income and future income taxes payable. For instance, if a company incurred a net operating loss in the year 2020, it wouldn't pay taxes in the year 2020 and can carry that net operating loss forward to 2021, 2022, and future years to reduce taxable income and income taxes payable. Under old tax laws, taxpayers could also carry net operating losses backwards. They could carry net operating losses backwards 2 years, and then any remaining net operating loss that wasn't used could be carried forward an additional 20 years. Current tax law, again, only provides for net operating loss carryforwards. The problem we work through will include both net operating loss carryforwards as well as net operating loss carrybacks. This is in case you come across a tax return that involves a net operating loss carryback in prior periods, or in case Congress restores the provisions of the old tax law that permit net operating loss carrybacks. The Johnston Corporation's pre-tax financial income or loss and taxable income or loss are the same for all years involved that appear below. In other words, there are no timing differences. We're going to assume a 45% tax rate for 2012 and 2013 and a future tax rate for the remaining years of 40%. We're going to prepare journal entries for all the years to record our income tax expense, the effect of net operating losses, and carryforwards. We're going to assume that all income and losses relate to normal operations, and in recording tax benefits related to loss carryforwards, we're going to assume that no valuation account is deemed necessary. In other words, it's probable that we will realize the benefit of tax loss carryforwards, that we will have taxable income in future years. We're given the taxable income for each of the years, as well as the tax rates. Notice they increase from 45% in years 2012 and 13 up to 40% in later years. We have net operating losses in years 2015 and 2016. Let's go ahead and take a look at our tax liabilities for each year and our journal entries. Our tax liability for 2012 will be the $173,000 in taxable income multiplied by the 45% tax rate. Our journal entry involves a credit to income taxes payable for $77,850 and a debit to income tax expense for $77,850. Again, recall, we were told there were no temporary timing differences. In other words, our pre-tax financial income equaled our taxable income. For 2013, we had taxable income of $246,000, a 45% tax rate. So our income tax expense and taxes payable is $110,700. In 2013, we had a tax liability of $32,800. And then in 2015, we incur a net operating loss. Under the provisions of the old tax law and in our problem, we're going to carry that net operating loss back to 2013. Recall, we had $246,000 in taxable income and paid $110,000 in taxes. We will be able to offset that income with this $173,000 net operating loss and be able to get a refund of taxes we have paid in the prior years. Our loss carryback is the $173,000 multiplied by the 45% tax rate in effect in 2013. We have a tax loss carryback benefit of $77,850. We record an income tax receivable in that amount and a credit to income tax expense, in other words, a benefit due to the loss carryback of $77,850. This leaves us with a remaining liability from 2013 of $32,850. We won't be able to recover that in future years because of the limitation of carrying net operating loss back only 2 years. We'll go ahead and take a look at our income statement for the year 2015. For 2015, we had income before taxes. We had a loss of $173,000. Then we have a benefit or tax savings due to our tax loss carryback of $77,850, leaving us with net income for the year of $95,150. So again, notice the net operating loss carryback saved us money in taxes. In fact, we have a negative tax expense or tax savings of $77,850. Our loss carryback then in 2016, part of it will be carried backwards to 2014, and part of it will become a deferred tax asset to carry forward to future years. We're going to carry back $82,000 of our taxable loss to the year 2014, and at a 40% tax rate, that provides a $32,000 tax benefit. Notice we record income tax receivable of $32,800, and we record a reduction in our tax expense in the amount of $32,800. The remaining timing difference, and again, that's going to be the $376 minus the $82,000 we carry back to 2014, leaves us with a timing difference of $294,000. At an expected future tax rate of 40%, we have a deferred tax asset of $117,600. We record a debit to our deferred tax asset for $117,600, and we record a further reduction in our 2016 tax expense in the amount of $117,600. Let's go ahead now and take a look at our income statement for 2016. We had income before taxes in the amount of $376,000. That was a loss. We had tax savings related to the carryback to 2014 of $32,800. We had a tax benefit associated with our deferred tax asset that we plan to carry forward in the amount of $117,600. So our total tax savings arising in the year 2016 is $150,400, and we will report net income then of $225,600. That's our taxable loss of $376,000, which equaled our pre-tax income, minus our tax savings of $150,000, giving us an after-tax net income of $225,600. And we've got a tax loss carry forward and associated deferred tax asset to carry forward to future years. In 2017, we have $128,000 in pre-tax and taxable income. At a 40% tax rate, this means our current tax liability is $51,200. But we can carry forward $128,000 of this originating timing difference to generate tax savings in the year 2017. The loss carry forward of $128,000 at a 40% tax rate generates a $51,200 tax benefit. We will record a deferred tax asset, a reduction in our deferred tax asset of $51,200 because we've used part of that carry forward, and we will record income tax expense for the year of $51,200. On our income statement, we had income before taxes of $128,000 that was given. Our current tax expense associated with that income is $51,200, but it's being offset with a deferred tax asset. So we have tax savings of $51,000, and we report net income of $76,800. In 2018, we report an additional $105,000 in taxable income, and at a 40% tax rate, that results in a tax liability of $42,000. But recall, we still have $166,000 in terms of an originating timing difference, in other words, a net operating loss carry forward, that we can use in 2018 and in years going forward. So our loss carry forward will be the $105,000 times our 40% tax rate, or $42,000. We reduce our originating timing difference by another $105,000. We reduce our deferred tax asset by the amount of the NOL times the 40% tax rate, the $42,000. And we record a reduction in our deferred tax asset of $42,000 and a debit to our income tax expense for $42,000. And we can notice at the end of 2018, we have a remaining net operating loss carry forward of $61,000, and at a 40% tax rate, that translates into a remaining balance in our deferred tax asset account of $24,400.